Next question. Personal Computer Division of Distress Limited, a computer hardware manufacturing company, has started facing financial difficulties for last 2 to 3 years. The management of the division, headed by Mr. Smith, is interested in a buyout. Highlight the portion buyout on 1st of April 2020. However, to make this buyout successful, there is an urgent need to attract substantial funds from, again highlight the portion, venture capitalist. Means there is basically the funds requirement. Ven Cap, venture capitalization, a European venture capitalist, somebody who is ready to make investment. Okay. Firm has shown its interest to finance the proposed buyout. Distress Limited is interested to sell the division, highlight the portion, for rupees 180 crore, and Mr. Smith is of the opinion that additional amount of rupees 85 crore shall be required to make this division viable. So use a calculator. 180 plus 85, there is a total requirement of the funds of 265 crore in order to make the business once again sustainable. The expected financing pattern shall be as follows. See, the total 265 crore, that is total of this loan, is the requirement. How they are going to finance? The management itself is going to make investment of 60 crore, and the venture capitalist will be told that you make investment of the remaining amount. So 265 minus 60, so venture capitalist is supposed to make investment of 205 crore, consisting of the equity financing of 22.5 crore, consisting of the debentures of 22.5 crore, and consisting of the debt financing of 160 crore. So the total of this three. So basically we understand that there is an equity financing of 22.5 crore and there is a debt financing of 182.5 crore. Okay, there is one more thing that is provided over here. So there is a debt financing of 205 crore. Now there is a new point which has been provided over here. 9% debentures with attached warrant of rupees 100 each. Now what do we understand with the term warrant? I explain that to you. See, basically what happens as a company, normally you have two financing pattern. One is the equity and another is debt. From investor point of view, again, there are two types of investment that you can make. Either you invest in equity or you invest in debt. Okay. Now from investor perspective, they know that say there is high amount of the risk when I make investment in equity, and the risk is less over here. Very negligible. There is only credit risk that they have, that is the company may default. Otherwise, generally there is no risk. At the same time, say if at all we talk about the return is high over here and the return is very low over here. So the investors are having say some resistance number of times to make the investment in the debentures. They do not want to invest in equity. Why? Because they do not want to take risk. Investor wants good return, at the same time they do not want to take risk. So there is an in-between solution, that the debentures may be issued with this kind of warrant. It means that what will happen, the company will tell to the investor that say if at all you purchase this debenture, then in that case, say we will give right to you that say you can buy equity shares of the company at a specific price after a certain time period. So what happens, I'd say that warrant will give you a right to purchase equity shares of a company say at a specific price. So what will happen if at all the company is say having good reporting, the company is making a progress, there is a growth in the company, then automatically what will happen, from the investor point of view, they have earned a regular income, and at the same time whatever this warrant which is attached to the debenture, that will give them say the additional benefit, because see you will be able to purchase the equity shares of the company at a predetermined price, whatever may be the spot price. So that will give you the additional advantage. This is what say we understand is something say the warrant about. See, the question says that so the warrant can be exercised anytime after 4 years. Okay, after 4 years you can buy equity shares of the company based on this warrant. From now, for 10 equity shares at the rate of rupees 120 per share. So what will happen, dear students? Whatever may be the spot price, you will have an entitlement to purchase the equity shares of the company at 120. So if at all you have completed a very simple chapter called derivative, then in that case you may like connect this with the call option. This is nothing else but it is a call option. You have right to purchase and not obligation to purchase. And of course, when you are going to exercise this right, when the spot is exceeding the exercise price. That is what we understand is so the term warrant that we have. The loan is repayable in one go at the end of 8th year. Okay. So this loan is going to be paid at the end of 8th year. Debentures are repayable in equal annual installments consisting of both principal and interest amount over a period of 6 years. Mr. Smith is of the view that the proposed dividend shall not be kept more than 12.5% of the distributable profit for first 4 years. Forecasted operating income, earning before interest and taxes, after the proposed buyout is as follows. So operating income is provided to us for the next 4 years. 1, 2, 3, 4. Income tax rate is only 35%. It is expected that it shall remain unchanged at least for 5 to 6 years. Need not to provide this, we always assume that. In order to attract Ven Cap, that is the prospective investor, Mr. Smith stated that, highlight the portion, book value of the equity. So what is the book value of the equity right now? The book value of the equity right now is 82.5 crore. Book value of the equity shall increase by 20% during above 4 years. So during this 4 years, it will increase, but that is at the rate of 20%. Although Ven Cap has shown their interest in investment, but are, highlight the portion, doubtful about the projections of the growth in the value as per the projection by Smith. Now the investors have a kind of doubt that say whatever this 20% growth which Mr. Smith is say giving an assurance, say will that be actually realized or not with these projections. Further, Ven Cap also demanded that the warrant should be convertible in, highlight the portion, 18 shares instead of 10 shares as proposed by Mr. Smith. So the Ven Cap has demanded that say we should be entitled to purchase 18 shares instead of 10. You are required to determine whether or not the book value of equity is expected to grow by 20% per year. So this is the first question. This is what you are required to decide. This is what you are required to determine. That's whether there will be a growth at the rate of at least 20% or not during this 4 years. Further, so the second question starts. If you have been appointed by Mr. Smith as an advisor, then whether you would suggest to accept the demand of Ven Cap of 18 shares instead of 10 or not. So you are required to determine whether so this proposal in the second part of the question is from the company point of view. The first part of the question is from the venture capitalist point of view. Second part of the question is from the company point of view, that whether the demand of the investor of 18 shares should be accepted or not. That is a simple question. I request all of you to go through the question and then we'll discuss how to do it. Let us answer the question. First point. Warrant means an instrument that entitles holder to buy equity shares of the company at predetermined price. Second, warrant holder has right, comma, not an obligation to buy shares of the company at the rate of rupees 120. Friends, in bracket write down exercise price. It is also given a name as strike price. Anytime after 4 years. Third, in this question, we have to verify from Ven Cap point of view whether to whether it will be able to get 20% growth in value of equity or not. Full stop. With paragraph write down. Further, from company point of view, we have to decide whether demand of Ven Cap for 18 shares should be accepted or not. Full stop. Now let us have understanding that say in what sequence we will do answer. Dear students, over here the first working note that say we need to prepare is the amount of the annual installment. The question is providing the information over here that this is the line with which we have to start with the answer. Debentures are repayable in equal annual installments. The kind of practically that we have EMI, equal monthly installment, over here it is equal annual installment, consisting of both principal and interest over the time period of 6 years. So the first working note that we will prepare is the amount of installment. The second working note that we have to prepare is principal and interest bifurcation of the installment amount. The amount of the installment will be divided, principal and interest. That is the second working note that we need to prepare. Why? I just explained that to you. Now after that, we understand that say we already have the operating income. So we are required to work out the further answer like this. Earning before interest and taxes. From that, interest will be deducted. The interest on the debenture as per that working note, and interest on the loan will be as it is. That will give us earning before taxes. Minus tax will give earning after taxes. There is no preference dividend. Then we'll deduct the equity dividend. It has been given that say they will not distribute more than 12.5%. So let us assume that the equity dividend is 12.5%. So we'll get the retained earning. Retained earning for the first year, for the second year, for the third year, for the fourth year will be added to 82.5. So we'll get the value at the end of the fourth year in terms of book value of equity. That is the way we'll compute the book value of the equity. Let us assume that it is an amount of, just I am taking a random amount, 100 crore. Okay. That is, this is 82.5 plus the retained earning is added and it becomes say 100 crore. The question says that Mr. Smith has given an assurance that you will get 20% growth in the equity value. So 82.5 crore into 1.20 raised to 4. So as per the commitment of Mr. Smith, the value should be equal to this amount. Let us say that this amount comes to an amount of 90 crore. Then in that case we will say that yes, Mr. Smith is correct. That you will be able to get at least a growth of 20% because at the rate of 20% of the growth rate, the book value of the equity should be 90. Actually it is 100. So 100 is more than 90. So it is like correct. It means that the contention of Mr. Smith is correct. And suppose this value is instead of 90, it is 110. Then we will tell to that is the venture capitalist that no, whatever the commitment that Mr. Smith is providing to you will not be fulfilled, will not be realized with the projection of the operating income that he has given. This is the way we are required to do answer. Dear students, we are required to make this calculation only for a time period of year 1 to year 4. We don't have to consider the information about the repayment of this loan. Why? Because it is at the end of 8th year. We are not concerned with that. Then we understand that over here, say the principal repayment, we are not concerned with that. Why? Because we are concerned with the book value of the equity. See, the language of the question is very, very, very clear. That is the best aspect of this question. So you just have to focus on the book value of the equity for the purpose of doing answer. Friends, in examination, we don't have to write any of this note. Directly we have to start with the answer. So I request all of you to start writing down answer along with me. Working note number 1. Calculation of retained earning I'm sorry, calculation of annual installment for repayment of loan. In that write down loan amount divided by PVIFA at rate of interest for n number of years. What is the loan amount? Loan amount is 22.5 crore divided by loan amount means say the debentures. Okay, the loan amount stands for over here, say the debentures. It is supposed to be repaid over the time period of 6 years. So divided by PVIFA at the rate of 9% for 6 years. Because it is supposed to be repaid over the time period of 6 years. Like that information is given. So it is 22.5 crore divided by PVIFA at the rate of 9% for 6 years. So 1 divided by 1.09, 1, 2, 3, 4, 5, 6. 6 years annuity factor is 4.4859. That is the way the annuity factor can be calculated. So it is 1 divided by 1.09. You press is equal to, then you add the same to the memory. Is equal to, then again you add to the memory. That is the way you are required to add this say for 6 times, and then you are required to do memory recall. You will get the 6 years annuity factor. So this is the way we are required to make the calculation of the annual installment. It is 5.0157 crore. That is the amount of the installment on annual basis. Working note number 2, calculation of principal and interest bifurcation. So what will happen, dear students? Column number 1 is year. Column number 2 is principal outstanding at the beginning of year. Then amount of the interest, and lastly it is principal adjusted during the year. That is the way we are supposed to prepare a small table. So year 1 beginning, the principal outstanding is 22.5 crore. The first year interest would be 22.5 crore into 9%. So the interest is 2.025. The installment is 5.0157. So what happens at 5.0157 is the amount that you pay against the interest of 2.025. So whatever the excess amount which has been given is towards principal. That is 2.9907 crore. That is the principal adjusted during the year. Second year beginning, It is 22.5 crore minus 2.9907 crore. So the amount of outstanding principal is 19.5093 crore. Now what is the second year interest? 19.5093 crore into 9%. That comes to 1.7558. This is the amount of the interest. So now we understand 5.0157 minus the amount of the interest. So again the excess amount is for principal. So the amount towards principal is 3.2599 crore. See what happens at friends, we are required to do this segregation. Only in that case we will come to know that individually what is the interest. Whatever the interest that say we compute, based on that say we will be able to make the calculation of the retained earning, because for that the earning after taxes and everything is required. Third year beginning, 19.5093 crore minus 3.2599 crore. That is 16.2494 crore. Now what is the interest? It is 16.2494 into 9%. That comes to 1.4624 crore. Next, 5.0157 minus 1.4624. That is 3.5533. Fourth year beginning, what is the principal outstanding? 16.2494 minus 3.5533. That comes to 12.6961. Now 12.6961 into 9%. So 1.1426. 5.0157 minus 1.1426. So the principal adjusted would be 3.8731. That is the way we will find the principal adjusted for the fourth year also. Now rest of the answer is extremely simple. We are required to prepare a small table, and with that we will make the calculation of answer. So working note number 3, calculation of retained earning, comma, from end of year 1 to end of year 4. That is what we are required to compute. For that we are required to prepare a table wherein we will start with the EBIT. From that interest is deducted, we find EBT. Tax is deducted, we find EAT. Dividend amount is deducted, we find the retained earning. Retained earning of year 1 to year 4 is added to the base value of the equity to compute value of the equity at the end of the 4 years. That is 100 crore which I had provided to you in my explanation. That is the way we are supposed to start. I want you to write in the chat box what is the amount of the retained earning for the first year, only for the first year. So we have the answer to be computed like this. For first year, we start with the operating income, earning before interest and taxes. That is an amount of rupees 48 crore. Amount of the interest on debentures that we already have calculated over here. First year it is 2.025. Again there will be interest for the loan. What is the amount of the loan? Amount of the loan is an amount of 160 crore and the rate of interest is 8%. Use your calculator. 160 into 8%, that comes to 12.8 crore, and definitely dear students, this amount of the interest is going to remain same. 12.8 crore, that is 160 crore into 8%. EBIT minus interest, that gives the earning before taxes. Earning before taxes, and then tax rate is provided to us. Income tax rate is provided to us as 35%. And the proposed dividend will be like 12.5%. So earning after taxes will be 65%. Okay, 35% is the tax. Then 100 minus 12.5. So you pay 12.5% in form of dividend. So retained earning would be 87.5%. That is 100 minus 12.5. So I request you to use your calculator. 48 minus 2.025 minus 12.8 is equal to 33.175 into 0.65, 21.5638 into 0.875, 18.8683. That is the amount of the retained earning for end of year 1. Similarly, second year onwards, we'll make the calculation. Try to do retained earning calculation from the second year to fourth year and put your answer for the individual year in the chat box. Chalo, second year, the amount of the EBIT is 57 crore. Amount of the interest is 1.7558, then 1.4624, and last year it is 1.1426. Amount of the EBIT is 68 and 82 crore. 57 minus 1.7558, that is 55 point, oh I'm sorry, this 12.8 is going to remain same every year. (57) minus 1.7558 minus 12.8, so EBT is 42.442, yes. 68 minus 1.4624 minus 12.8, 53.7376. 82 minus 1.1426 minus 12.8, 68.0574. 35% is the tax rate. So 42.442 into 0.65, that comes to 27.5887. 53.7376 into 0.65, 34.9294. 68.0574 into 0.65, 44.2373. Again 12.5% is paid in form of dividend. So 82.5 is the retained earning. Sorry, 87.5 is retained earning. So 24.041, 24.1401, 34.9294 into 0.875, 30.5632, 44.2373 into 0.875, 38.7076. That is the retained earning from end of year 1 to end of year 4. Next is, this is the way the retained earning is calculated. And of course friends, so this is the most important working that we have in the entire question. Working note number 4, calculation of value of equity after 4 years. We understand that it is 60 crore plus 22.5 crore plus 18.8683 crore plus 24.1401 crore plus 30.5632 crore plus 38.7076 crore. So it is 82.5 crore plus 18.8683 plus 24.1401 plus 30.5632 plus 38.7076, 112.2792. That is the amount of the retained earning which is added to 82.5 crore. So this is the value after 4 years, 194.7792. This is the value of the equity after 4 years. Next, working note number 5. Calculation of value of equity after 4 years, comma, considering growth of 20% per year. So friends, we will check that, say, what should be the value of the equity considering 20% growth for 4 years. If it is greater than this, then in that case contention of Mr. Smith is not correct. And if at all, say it is less than this, then in that case we understand whatever Mr. Smith has committed is true, and say the 20% return that the investor will be able to get. Investor means over here venture capitalist. Current value of equity into 1 plus g raised to n. Current value of equity is 82.5 crore into 1.20 raised to 4. So 82.5 crore into 2.0736. So 171.072. So considering the 20% of the growth on annual basis, the value should have been 171 and actual value is 194. So 194 is greater than 171. So the book value of the equity shall increase by not 20% but more than 20 percentage. Why? Because the actual value of the equity is greater than what it should have been, considering 20% of the increase. Okay, so this is what we understand is the increase. Dear students, based on this we can write the conclusion that contention of Mr. Smith is correct, that value of equity shall increase by 20 percentage during 4 years. Full stop. Rather, value of equity increases by more than 20 percentage during this time period. How we can say it is more than 20 percentage? Because 194.7792 exceeds 171.072. That is the way so we can draw the conclusion. Now sometimes students are having a question to ask me that, sir, if at all we want to compute the actual growth rate, can we? Yes, you can. If at all you want to calculate the actual growth rate, uh, the rate at which the value of the equity is increasing, can we compute? Yes, you can compute. For that, say we have to put the answer like this: calculation of actual growth of book value of equity. In that it is 82.5 crore into 1 plus g raised to n is equal to 194.7792 crore. Now g will be calculated as balancing figure. So over here we can compute the answer like this: 1 plus g raised to 4 is equal to 194.7792 divided by 82.5. So over here g will be calculated as 194.7792 divided by 82.5. Now it is raised to 4. When it will be transferred on the opposite side, it will be raised to 1 by 4. And this positive 1 will be transferred on the opposite side and it will become negative 1. That is what we understand. So we have to do answer of the question like this. It is 194.7792 divided by 82.5. So you get the answer as 2.36096. 2.36096 raised to 1 by 4. minus 1. So what you have to do, friends, you have to press under root for 2 times. You'll get the answer. In that case, you get the answer as 1.2396 minus 1. So it is 0.2396. That is 23.96%. So friends, we understand that say that is a growth rate of 23.96%. If at all, say the company is having say this amount, this projection of the earning, and definitely 23.96 is exceeding 20%. So contention of Mr. Smith is correct. Friends, I generally recommend that say do answer with this method only instead of this method, because doing answer with this method was very simple this time. Why? Because this time the time period was exactly 4 years. If at all the time period is other than 4 years, then making this calculation, let us say that it is 3 years or it is 5 years, then making this calculation would be quite complicated. So I generally do not suggest to go with this method. But since I come across to this kind of question, I have explained this to you. Now the first part of the question is done. The second simple part of the question. Further, you have been appointed now by Mr. Smith, okay, from the company point of view. Let's say whether to accept the offer, that is the demand which they have put. Let us understand and say how to make the calculation of answer. So write an answer for that. We'll prepare a working note. Why do we prepare working note? I just explained that to you. Working note number 1, calculation of number of equity shares held by management, comma, held by venture capitalist. Number of shares per warrant. We have offered 10 and they have demanded 80. Then shares held by one is the promoters, that is management, and by venture capitalist. As far as the promoters holding is concerned, we understand that it has been given to us that they are going to have the investment of 60 crore of equity share capital and face value is 10. So we understand that it is 6 lakh number of shares. So it is 6 crore is the number of shares. It is 60 crore divided by 10. Now as far as the venture capital is concerned, we can see that the information is given that say initially we are giving 2.25, okay. Then we have been provided that say this is the value of the debentures, okay. Face value of the debenture is 100 and warrant is 10 equity shares. So understand carefully friends what I am going to write over here. This is going to be important for you. It is 22.5 crore divided by 10. So this is the initial number of shares which have been issued, that is 2.25 crore plus, understand it carefully, it is 22.5 crore is the value of the debentures divided by 100. This is the number of debentures. Whatever the number of debentures that we have into, we understand that say we have offered 10 equity shares for one warrant. So you can use the calculator. 22.5 upon 10, that is 2.25 crore, plus 22.5 crore upon 100, that is 0.225 crore debentures, into 10, that comes to 2.25 crore equity shares. So in that case, it is total of both of them is 4.5 crore. Now whatever they have demanded, based on that, say what will happen? This is of course going to remain same, 6 crore. This is also going to remain same, that is 2.25 crore. Plus, listen carefully, this is 22.5 crore divided by 100 into 18. Okay, why 18? Because we understand that they have demanded 18. So 22.5 upon 100. So 0.225 into 18, that is 4.05 crore plus 2.25. So the total it comes to 6.3 crore. So friends, understand carefully that say what will happen? Whatever we have offered them, in that case, say we will be having say the more number of shares than them. Whatever they have demanded, in that say they would be having more number of shares than us. So ultimately what will happen? Control of the company will be passed on, say to the venture capitalist, if at all we accept their offer. So Mr. Smith is advised not to accept that offer. So let us answer further. Mr. Smith is advised not to accept demand of Ven Cap venture capitalist because they demand such number of shares which have possibility of losing control over the management of the company. So percentage of the holding by venture capitalists would be more than percentage of the holding of the promoters. A small summary of the entire answer. First of all, I have given explanation that say what is warrant. That is a given explanation to you that say there are basically 2 points. One is that say we are required to verify from the venture capitalist point of view that say whatever the promoters are having, say kind of assurance whether it is true or not. And the second is that say from company point of view, we have to decide that say whether the demand of the venture capitalists of 18 equity shares, say we should say yes or not. Then simple working notes with which we start with the answer. The first is a kind of EMI, equal monthly installment, that we have practically. This is equal annual installment. Then we do the principal interest bifurcation. Of course friends, we understand that say over the 6 years the loan will be entirely repaid, but we don't have to do it for entire 6 years. We have to do it only for 4 years because the question says that say you're required to verify that within 4 years you will be able to get a growth rate of 20% or not. And logically you can understand, use a calculator along with me. 5.0157 into 6, So you can see that say you pay approximately 30 crore against 22.5 crore. So the differential amount is say the amount of the interest 7.5942, which will be spread over the time period of 6 years. So we have made the computation of the principal and interest bifurcation. This is necessary because we understand that so the interest is an allowable expense from tax point of view, and it is required to be deducted for the purpose of tax calculation and even for the earning calculation. Then the third working note is the most important, the amount of the retained earning. Question is providing that say the loan is repayable in one go at the end of the 8th year. We understand that say by using the common sense that interest would be paid annually and the principal will be repaid at the end of 8th year. Operating income minus both interest, that will give EBT, minus tax is EAT, minus 12.5 percentage, because the language of the question speaks that the equity dividend, Mr. Smith is of the view that proposed dividend shall not be kept more than 12.5 percentage. So it will be, let us say, 12.5 percentage. It may be less than that, but it can in no case more than that. So we have computed 87.5% of the earning after taxes. That amount of the retained earning is added to the book value of the equity right now to compute the value of the equity at the end of the 4th year. This 194.7792 is the value at the end of year 4. This is year 4 end value. Now considering a growth of 20%, value should have been 171.072. This is the value it should have been year 4 end. But actually the value is more. So yes, whatever this Mr. Smith says is correct. The second thing that we understand is that say we can compute even the actual growth rate. In this example it is very simple because the number of years are exactly 4. So we find that so the growth rate is 23.96%. Based on this also you can draw the conclusion that contention of Mr. Smith is correct. 23.96 is exceeding 20. Then the second part of the question, to draw the conclusion for the second part, I have prepared a small working note that what would be the number of shares that say we would be having and they would be having. We means the company and they means so the venture capitalists. We can see that say if at all we accept their demand, then in that case the number of shares held by them would increase the number of shares held by us. So we deny that, so no, we are not interested. That is the way we are supposed to say give answer. Because if at all we accept the demand, then ultimately what will happen? Ultimately, say the control of the company will be passed on, say, to the venture capitalist. Now, if at all it happens that, just an additional point, if at all it happens that, suppose this comes less than 6 crore, suppose this comes less than 6 crore, then in that case, we can tell to Mr. Smith that, see, giving lower number of shares is always preferable. In a way that say, it shows that say you are able to bargain good. But if at all that say they deny to give say the funding unless they get at least 18 shares, then in that case you can accept. We understand that say this is a kind of homework which is going on from Mr. Smith point of view, and we understand that say you can afford, but every time you don't pay whatever you can afford, you'll try to bargain so far possible. So definitely we can say that say you can accept their offer, you can accept their demand. However, of course, you try to negotiate so far possible. So this is the way we can draw the conclusion.